All right. There we are. Okay. Welcome back from the break, everybody. You're in for a real treat now. We're going to have a conversation with Bill Coren, who's a partner at Sequoia. Bill has quite an amazing background, and he's sort of been a little bit of everything. So he has a PhD in computer science from Stanford. He's run very significant, large operating engineering teams, first at Bell Labs, and then in 2003 he joined Google, and he ran teams up to 5,000 people that were doing some of the hardcore tech for search and other aspects of Google. And then in 2011 he joined Sequoia, and he's been an investor ever since. So please welcome Bill Coren. We're going to have a great conversation. We're going to address all the things I'm sure you want to know about their new fund and a little bit of the doomsayer stuff. And we're also going to talk a lot about Bill's thoughts in terms of his passion of coaching entrepreneurial founders who are developing technical solutions. So, Bill, thank you so much.
Thank you for the invitation. I'm glad to be here.
Great. Wonderful. So let's dive right in. Let's start with Sequoia's evolution. Right, so during the pandemic and prior to current market conditions, Sequoia made a really significant change in the evolution of its fund structure to a permanent fund. I was wondering if you can give us a little bit of the insight into what led up to the change in terms of the thinking behind it, and also what the new structure is in a little more detail than we might have read about.
Yeah, I think the major motivation was a number of the companies that we work with, and we often stay on the board of our successful companies well into their public runs, and we notice that as our stock gets distributed from those companies, it often gets sold by the LPs, and in many cases, there's as much value to be created after a company goes public. In some ways, an IPO is just the starting point. When I think of Google, I think Google came out at its IPO at $85 a share, and people who sold at that price probably would regret it today. So a lot of it was so we could hold our public stocks and continue to think about how to continue to view them from a valuation standpoint. We still, inside the evergreen envelope that we created, have vintage funds for seed, venture growth, and so forth. So we continue to have differentiated teams that are focused on different parts of the kind of growth curve of companies within that fund, but then it's held in that overarching structure. So.
Thank you. I think that one of the things that we all have to deal with as well is what to do once our portfolio companies go public and whether to keep and hold. And we have those same sort of conversations within ourselves and also with our LPs or our corporate. How did your LPs react to that new approach? Because in some ways it changes the duration of the fund and can make it sort of a different asset.
I was the vast majority of the LP base was actually pretty enthusiastic and agreed to kind of convert into the new fund structure. They to get cash out and so forth, they do have to redeem and make requests to get cash out, but most of our long-term LP base are very long-term investors that think in 20, 30-year time horizons, so they're not necessarily thinking about 10-year fund cycles, they're thinking beyond that.
So they got to opt in or out.
Yeah.
You also became an RIA during that period, so what strategy did that support, and how did it impact your operations?
Yes, we did register, which was a major decision for us. Part of it is we are long-term bullish on crypto and blockchain technology, and we found that there was some restrictions without being restricted, particularly being active in the crypto space, and so that was part of the motivation. The other was to have more flexibility to purchase secondaries or existing public company stocks, so that it gave us more latitude for that.
I see. Do you think that a 10-year fund is obsolete for most investors at this point? Or having only a 10-year plus one or two fund is obsolete?
I still think it makes sense to have metrics around different classes of funds. I think how you evaluate a seed investment fund or a kind of Series A venture fund or a growth stage fund, they have different metrics and different goals. And so I think it makes sense to retain teams that have focus on different parts of the business and to measure their performance in a given period of time. Whether there's a particular legal structure that supports that or not, I think that's up to debate. But I think in terms of measuring performance, it's very important, and also the outlook of the team that's doing the investing.
See. So now in hindsight, after these changes to the permanent fund and the RIA, and now we've also had market changes, in hindsight, does it still feel like it was the right choice? Does it just give you more flexibility, or are there other thoughts on that?
Yeah, I must say it's been interesting to watch valuations come down to earth. Speaking for myself as an individual, not for Sequoia, I'm actually glad to see some rationality returning to the markets. I think valuations had run up to kind of a crazy point, and in particular, I think a lot of investment deals were things that had to be prosecuted in less than a week with very little diligence or thinking about what was going on. And so I actually welcome the change, and I think Sequoia continues to be long-term bullish on tech. And so even with the valuation changes, and we think it's still a great time to invest.
I see. Between your operating career and those recent years as an investor, in addition to having that feeling like maybe it's good to have a reset, what specific tactics do you think investors should take during this dynamic period, right, where there's a lot of uncertainty?
I think the main thing that all of us should be looking for is what are major changes that are going on in the industry. A lot of there have been kickoffs of different kind of waves of innovation. In some ways, I would say smartphones and mobile was one of the last major ones. Some people would argue that crypto and blockchain is a new one. But I think looking for where the technology landscape is really going to change and alter is what we should all be doing. I worry sometimes that we become too fixed on whatever pattern we've used the last few years, and you need to always be thinking about what's new and reinventing your perspective on where things are going.
What do you think are some of the things that an investor can do wrong in a period like this, other than sort of being stuck in an old pattern? And also, from that perspective of the entrepreneur, what are some things that you think entrepreneurs can do wrong in a period like this?
Well, I think one of the things that's going on in the industry right now, when you look at both the entrepreneurs, the founders, and the investment community, I think there's a very complicated dance going on that's essentially price discovery. I think the founders would like to get investors to pay the 2021 price, and investors would like to pay the 2022 price. And I think both sides don't want to embarrass each other, and so I'm seeing in some of the price negotiations around deals now, there's a lot of confusion about should I take a down round, should I think about can I try to wait longer to raise more money and so forth, and it's very complicated. I think for investors, unless the company is extraordinary, you shouldn't be paying the 2021 price, in my opinion. So
I think we're all trying to avoid that. Absolutely.
I know we are all trying to, but I assure you founders show up and saying, but last year I got XYZ as a valuation, and I deserve 2 XYZ now. Right. So
I think we're all hearing that too, right? You talked about how maybe we're going to go back to having due diligence be a little longer than a week. And I think, in recent years, we saw lots of non-VC and non-CVC firms enter the market, including hedge funds and PE firms. And we saw firms like Tiger Global and SoftBank, yet again, playing with a particular approach, right, in terms of being kind of valuation and due diligence independent. Any thoughts on how their pulling back will impact the market, and will we go back to how things used to be, or is there sort of a fundamental change in the playbook?
Well, there's still a lot of capital in the system, and I think as you can get returns from things other than venture capital type investments, I think we will see money flowing out of this part of the ecosystem. And so I do think there'll be some resetting, but until the sort of excess capital exits, I think we're going to have a period where there's still going to be very aggressive kind of index style investing. I must admit, I strongly prefer to understand the companies I'm investing in.
I can understand that. I think we feel similarly. In terms of the current market, Sequoia has been very vocal in sort of calling the change, calling the reset, in some cases kind of earning the moniker, the doomsayer. And I think over the past years, we've seen certain VC funds like Andreessen and some others be very vocal in the media, and I think Sequoias tend to be quieter. And so I know, to me, seeing the public sort of face of Sequoia and talking about the market was somewhat surprising. I'm curious what went into the thinking about being public about that at this moment.
Well, we originally gathered our founders mostly on video and did a presentation of what we thought about how the market was changing. Not surprisingly, a lot of that information leaked into the market, so I'm not sure we were trying to do a lot of PR, but we didn't then release the information that we'd given out. I guess our view is we're exiting a period where growth at any cost is a kind of mantra that companies should obey, and companies need to think much harder about building sustainable businesses. That doesn't necessarily mean they have to be profitable next week, but it does mean that just pouring more and more capital in to accelerate growth without having good sales metrics or good kind of metrics around the performance of your business, I think it does make sense. And so we were cautioning our founders to at least think about their runway, try to think about what they're going to have to do to prove to an investor to raise the next round and so forth. And we think that's the new world. Mm-hmm.
One of the words that's been kind of running around here in the last day or so is the word profitable, and hearing that in boards sometimes. And I wonder about that. And so there's sort of having your cash runway, and then there's a strive to be profitable, and that feels sometimes it's certainly at odds with the previous years. But also, what is the timing for being profitable along the arc, and does it have a role, and does that change in a time like this?
Yeah, it's interesting. I think a number of the companies that I work with could become profitable fairly quickly, but they would probably then stunt their growth and end up being a much smaller outcome. And so I think a lot of the question from my perspective, and I think from the Sequoia perspective, is what does the arc of the company look like, where it's thoughtful growth, thoughtful capitalization, and where there's a point where you can see that it'll become profitable and become a strong business, but you want to make sure you don't collapse the growth by rushing to profitability. And so we try to balance that thinking. It also means that the companies have to be fairly objective and thoughtful about where can they end up, because after all, the public market is basically looking at discounted cash flow and thinking out a few years, and at some point, if the returns are not good enough, the stock price won't be supported. And so I would say the board of every company has to think long and hard about what the right strategy is.
And now, in this moment, how are you finding the conversations with some of the entrepreneurs that you're working with and coaching? How are they handling sort of the change in the market, and whether it's that tension between growth and future profitability, or whether it's just changes in valuations? How are they handling it, and how are you coaching them?
it's interesting. There's a variety of reactions. I think a lot of them are looking very hard at their operating plans and trying to think about what can I do to extend my runway? How do I meet certain financial metrics and business metrics that let me raise a round at a significant price? And so there's a lot of that going on. Frankly, there's a number of the companies I'm working with are actually relieved because they feel like they'll now be evaluated as a business, and they felt like the last 2 years or so there have been company financings for things that didn't really appear to be companies. And they find that very frustrating. So I would say they're happy to embrace reality and kind of meet the market.
Is there a difference in the reaction for those who are first-time founders and those who are more serial founders? Different perspective?
It's interesting. I mean, a repeat founder often has had to go through some heartache along the way. But I would say we have not had a downturn like this since the 2008, 2009 time period. And so even with experienced founders, I think a lot of people have sort of forgotten what it's like to live through a period like this. And so there's a lot of relearning going on. And I must admit, now being an old guy, I find people asking me questions like, what was it like in the 1970s? You know, so it's like Back to the Future again that we're going through, I think, so.
So when you're telling them what it was like in the 70s, or you're telling them other things, what are you finding to be the most helpful messages to them about navigating through this? Because I think it can challenge and make anxious even sort of the strongest, founder.
Yeah, I would say when I spend time with the founders that I work with and talk to them about their issues, I think a lot of it is being very realistic about where you are as a business and a team, and trying to think about, do I have the right team? Is the team too big? Is the team too small? Are there places where you should up-level the team and make some changes and so forth? And I would say in the financing period we were in before, I think there was kind of a rush to do everything very quickly and kind of damn the torpedoes, full speed ahead. And I think now founders are having to spend time actually thinking very deeply about their business. What is it? What can it become? Some of them, I think, will reach the conclusion that maybe they need to find an M&A outcome or whatever. But I think there's a reality check going on for a lot of founders.
Mm-hmm. So we just spent a little bit of time talking about kind of engaging with and coaching the founders during this sort of reset. But more generally, how do you find your own extensive experience in operating roles and as a founder, as a technical founder, how do you find that experience translating into your role on the board and generally as a coach for founding teams and technical founding teams?
Well, it's interesting. One of the things that I sometimes talk to founders about is many of them are, for example, in awe of Google. And I was at Google from 2003 till when I joined Sequoia in 2011. There were periods of time at Google during those days when things were not as certain as it seemed from the outside. I oversaw search and a number of the other product engineering groups. We had real challengers, we had real issues, and I sometimes will tell founders, give them some glimpse into what to them looks like a massively successful and indeed a massively successful company, but nothing is up and to the right constantly. And so a lot of it is just grounding them in the idea that you need to think very deeply and don't panic. You need to spend time and contemplate things. And by the way, most of the time, they need to think about things before they make decisions, right? I've seen companies take very radical letting a lot of people go or making significant changes to their business without having thought it through enough. And so part of it's just getting people to have a tempo where they think about things and take some feedback and use me as a sounding board to should we do this or that? But of course, at the end of the day, it's the founder's company, and they need to make the decision on their own.
I think that for all of our different firms, and then also for companies, no matter how successful, right? There's always the dining room, and there's the kitchen, right? And so maybe that's true even for Google during those times.
I think that's true.
Yeah. Having been involved in so many companies over the arc of their experience, are there certain patterns that you find that when you're dealing particularly with an early stage founder, what are the different patterns that you draw on or that you find repeating again and again in terms of how you support them in key milestones, whether it's big positive milestones or some of those more challenging kitchen type milestones?
Well, for early stage companies, and Sequoia focuses on tech investing, I often get involved with founders at a seed or Series A stage, and the founding teams are often technical teams. And then one of the things that I've found as a consistent failure mode is the technical teams often do not value simplicity, ease of adoption, difficulty of sales, and so forth. They neglect a lot. They unfortunately, the most extreme example is the build it and they will come kind of thinking. And so, particularly with the young founders that are mostly technical, a lot of it's getting them to spend enough time thinking about what problem am I solving? Why is it a real problem? Why will people care? What's the impediments to buying? What kind of sales motion will I need over time, and things like that. And that's a major issue with a lot of young companies, I would say.
So switching gears, in advance when we chatted, we talked about the audience and who we had here. And it's pretty much entirely corporate VCs. And during your years as a VC, what has been your involvement with CVCs as co-investors or in the board, et cetera?
Yeah, so I was on the executive committee at Google most of the years I was there, and so I was one of the committee members that oversaw GV. So I certainly got exposure to that from that period of time, and then we've been involved with deals that have Intel Capital as a lead. We've had very good experience with Koch Industries as a lead. Part of the reason I'm here is George Hoyam from In-Q-Tel called me and said, would you mind coming to this event and doing this? And I said, happy to. So I've worked with a number of different groups, and I think corporate VCs, bring a lot of perspective about what's going on in their industry and the market that their corporate parent lives in. And I think that's very valuable because it helps, ground companies in the realities of what they're doing.
Historically, corporate VCs have sort of divided or been very, very strategic. And I think people try to categorize us as being either financial or strategic. And I tend to think that those that are 100% financial are really not CVCs, and they're perhaps treasury functions. But many of us are pursuing both strategic goals and financial goals, and many of us are financial first. But I'm curious, though, and we also see some institutional funds building platforms that have sort of strategic benefit to a range of their different LPs. And so I'm curious, what's your thought on how possible it is to achieve those two goals simultaneously?
Well, I think a lot of it depends on whether the individual partner at a CVC joins a board. Because I think if you're on a board for a company, you have to be the fiduciary for the stockholders of that company. And even if you're coming from a strategic investment group, I think you have to think about the company first. And so for me, a lot of it depends on whether you're part of a firm that's leading investments, taking board seats or not. I would say one of the challenges I've seen with strategics investors is they're often perceived as a pre-acquisition of a company. And so one of the things I've seen a number of companies do, if they're taking money from corporate VC from company X, they want to take it from competitor Y as well to kind of balance and not look like they're being owned by a particular entity. And I think that's something that a strategic CVC needs to think about as they get involved.
Yeah, I think there are many CVCs who are, or some who are sort of pre-M&A in terms of their goals, and there's others who are very partnership driven. And I think that similar to traditional VCs who both have the fiduciary responsibility to the startup, but also they have their fund and their LPs, we also are navigating that same thing.
Correct.
I think we're about out of time, so I'll ask you a final question.
We're getting the hook right there.
You could start your career again now. And with all the knowledge you've accrued as both an operator and an investor, at this moment in time, with everything that's going on, would you rather be a VC or an entrepreneur?
I'd rather be an entrepreneur. I've certainly enjoyed the young companies I've worked with, and at this stage of my career, one of the things I'm trying to do is give back, and that's important to me, but I'd rather be an entrepreneur.
It's in your heart, right?
Yeah. Thank you very much.
Thank you.